Chuck Arkwright, the CEO and Chief Investment Officer at Arkwright Capital Management, and his partner John Neff are two of very few investors who buy long-term compounding machines and just hold them. Now, this is a rare trait amongst Wall Street fund managers, as only 23% of actively managed mutual funds outperform their passive rivals. These two investors have managed to consistently beat the market since 2010, more than a decade, and that is something that the majority of fund managers fail to do. So, how have these two at Arkwright Capital Management managed to do this? Chuck has summarized the reasons for his outperformance into three simple steps in the analogy of a three-legged stool. Chuck says first, you look for an extraordinary business. Secondly, you look for talented management. And lastly, we want a business that has great reinvestment opportunities and histories of it. All this to further compound the earnings. And here's what Chuck has to say about that.
Talked about that, called the three-legged stool. And so the first leg is understanding exactly what the nature of the business is and what kind of returns on the owner's capital does it produce. And then we want to see if it has the ability to do that for a long time, if the runway is wide and long, we say. So what's causing that above average rate of return to exist? What's going on? What's unusual about that business? So the second leg that we look at is the people who run the business. And we're very focused on the skill level of the people who run the business and look at their record, whatnot. But we also want to know that they're acting in the best interest of all shareholders. That is, we see that what happens in the business happens to us on a per share basis. And then the last leg of it is the issue of reinvestment. So we examine how it is they have reinvested free cash flow in the past, what the outcomes have been, and they rarely break those out, by the way. We have to do our own work. And then what the opportunity for reinvestment going forward is, because the fact that they can reinvest all of their free cash flow to earn above average returns enhances our compounding effect, and that's what we're after.
So, if the first leg of this stool is to find an extraordinary business, what does Chuck mean by this, and what does he describe as an extraordinary business?
And extraordinary companies.
Compounding machines.
The compounding machines, right. So why is it so hard to find those companies?
Well, they're scarce.
Yeah.
They have something unusual going on, and oftentimes it is not completely obvious as to what it is that's going on. A great example of that would be a company like MasterCard or Visa. They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue, that sort of stuff.
Why don't you like to talk about it?
I don't think we're giving away anything, but I just want to make sure we're not.
Okay.
It's just that simple, you know. And so the other side of that is a company like that earns rates of returns on the owner's capital that are so extraordinary that they don't have a good opportunity to reinvest their free cash flow in ways to continue to earn those above average rates. So what they do with their free cash flow is they buy in shares, they pay a cash dividend, they make small acquisitions in technology around their space, but it's a challenge to utilize all the free cash they generate. And unlike our ideal company is one that can keep reinvesting and earn outrageous returns on capital.
Right.
Another thing that has led to Chuck's performance is his ability to stay concentrated in good positions. This goes against modern conventional wisdom about being diversified. Both Warren Buffett and Charlie Munger advise against diversification. Warren has said, diversification is protection against ignorance. Buffett said, it makes little sense if you know what you are doing. A lot of great fortunes in the world have been made by owning a single wonderful business. If you understand the business, you don't need to own very many of them. And then Charlie, adding to the fire, calls it diversification, saying, why would you put your money in your 10th best idea when you could have it in your first, second, or third best idea? Charlie is strongly against diversification, just like Chuck Arkwright. They believe the more diversified you are, the more your returns will revert to the mean.
Now,
And the other part of my question should be, when I talked to you in 2014 that you had 30 holdings, you're now down to 17, you've got a ton more money. Shouldn't you have more holdings? So go ahead.
Right. So we always talk about our ability to do better than average.
Right.
And so when you think about average, so when I think about average, I don't necessarily think of our AUM. What I think of is our ability to stay concentrated. So give me an example. If you flipped a coin, the average outcome would be that 50% of the time it would be heads and 50% of the time it would be tails. The more coins you flip, the more likely you are to get to average. 50% will be heads. The fewer coins you flip, the more likely you are to get an outcome that deviates positively or negatively from average. And I think
so you're flipping coins, Chuck. You didn't know that. Okay.
So,
okay.
but that's what I mean by
So that's the philosophy.
So it's really not about our AUM. It's our ability to stay concentrated in our highest conviction ideas, and our AUM hasn't been a problem to date.
in 2014, if we had 30 or 35 holdings, we would have been at that point in time less confident in those names than we are in the 17 holdings today.
Okay.
So if you see our holdings go to 35 again, you should just understand that it means we are less confident in the characteristics of the group as a whole, and that's why we have it spread out. And then the concentration, pure concentration, is we want to have as much money invested in the great businesses as we possibly can, because our return will come from their good experience. We will be riding on the back of those great businesses. So that's why we want to have all this, our capital concentrated in those things.
As you can see here at Arkwright Capital Management, they have a total of 18 holdings. And of those total 18 holdings, the top 5 here, from MasterCard down to O'Reilly Automotive, make up a combined of 64.06% of the entire portfolio. And their two favored positions, MasterCard and Visa, make up combined almost 29%. So as you can see here, these guys put their money where their mouth is. And you can see the level of emphasis super investors put on concentration. One big mistake investors make is cutting their flowers. Peter Lynch once said, "Don't cut the flowers to water the weeds." By this it means don't sell off your good investments to put more money into a bad investment in an attempt to reduce its loss. To avoid this, Chuck Arkwright and his partner John Neff avoid sell targets.
Interesting is that you had told me over the phone that you don't have, that another differentiator is you don't have sell targets.
Correct.
At Arkwright.
That's huge.
So if we've identified a great business, a compounding machine that we've purchased well, we want not to interrupt that compounding unnecessarily by curtailing it with a sell target. We want these businesses to continue to compound, and we want to own them as long as they continue to be exceptional. So no sell targets, only buy targets.
So, after all of that, what can we take away from today? The first is to buy extraordinary businesses, stay concentrated in those positions, and hold on to the compounding machine for as long as possible. So that's about what wraps us up for today, guys. Thank you guys for watching. If you enjoyed the content, please like and subscribe, and I'll catch you in the next one.